Hello and welcome to today's broadcast with Checkin.com Group. Joining us today are CEO Christian Karlsson and CFO Martin Bäuml. We'll begin with a presentation followed by a Q&A session. If you wish to ask any questions, please submit them via the form located to the right. And with that said, please go ahead with your presentation.
Thank you, and good morning, and welcome to today's webcast. My name is Christian Karlsson, and I'm the CEO. And together with our CFO, Martin Bäuml, I will take you through our report for the third quarter of 2025. I hope you had a chance to review the report this morning, and we're very open for questions later on. The plan is that I will talk about the company's overall development, and Martin will go through the financial parts. During the quarter, we saw a very big improvement, especially around our EBITDA margin. But at the same time, we continue to hunt for growth. For the quarter, our revenues was 17.4 million Swedish kronor, which is representing a 4% decline from the previous quarter. The decrease is mainly driven by a little bit lower volumes towards the travel and the iGaming segment out of the quarter. So I already talked about a little bit from the start, but the revenue in the quarter was like -4% compared to the previous quarter and -6% compared to the same period last year. At the same time, we continue to streamline the organization to find profitability and also give us opportunities for growth going forward. We see, especially with the cost focus we had over the past 6 months, that it now really starts to show in the numbers. The EBITDA margin for the quarter was the second highest for the company's history. And we continue to work into aiming for profitability and growth. And we expect the majority of the cost savings are expected to have a full effect during the fourth quarter. After the end of the quarter, we signed an agreement with a large fintech company, Visma Group. This agreement will mean that we will be an integrated part of their platform. And there has been a strong interest from their customer to accessing the technology we can provide. Why this is important, but it also allows us to reach a lot of more verticals and also give us a fantastic distribution channel opportunities to really scale our software. We also expect the first customers to use our software in the coming weeks already. Also, after the end of the quarter, we signed an agreement with New Zealand's largest casino group called SkyCity, which is the plan to also go live in the end of the year. It's worth to mention, like this type of agreements, it comes with like a monthly license fee from the signing date, followed by a variable model based on the volumes of traffic running through the software after the live date. We at the same time see quite strong demand in so-called omnichannel solutions, meaning like companies transitioning from physical environment to a digital one. We've also previously partnered with the French group Casino Barrière within the same segment that we also expect to go live at the end of the year. Going forward, we believe the iGaming vertical will continue to develop in a positive way for us, and we see a quite strong momentum right now. The market for biometrics and facial recognition solutions is expected to grow by around 15% annually on a global scale. Our assessment is that there are both directly and indirectly around like 4 to 5 million companies that is in need of this type of technology. The development is primarily driven by global regulations, stricter requirements to verify who the end user really is, and a growing threat from AI fraud, or so-called deepfakes. At the same time, in the industry, we also see an ongoing consolidation trend, where we mainly see multinational companies acquiring specialized players within this field. About our financial targets, our financial targets has been this classic sales metric, the Rule of 40, which measures profitable growth. The goal has been to maximize the sum of the growth per share combined with the EBITDA margin, with the ambition to reach 80% over time. We have previously communicated that we will not meet the targets for 2025. And yesterday also was decided through the board that we will suspend this goal until further notice. And with that, I will leave over to our CFO, Martin, to review the financials.
Thanks, Christian. Yeah, the quarterly report itself is filled with a lot of numbers. So here we'll go through the headlines. So net revenues decreased to 17.4 million kronor in the quarter, which corresponds to a growth of -6%. We had some negative impact from exchange rate. So if we adjust for that, the growth was -3% instead. And if we compare it to the previous quarter, i.e. the second quarter of 2025, the growth was -4%. And gross profit for the quarter amounted to 12.7 million kronor, and that was a margin of 73%. And EBITDA was 6 million kronor in the quarter, and that was a margin of 35%. And as Christian already mentioned, that's actually the second highest quarter in the company's history. Cash flow from operating activities amounted to a little bit less than 300,000 kronor, and we ended the quarter with a cash position of a little bit more than 14 million kronor, and the equity ratio was 92%. If we look into the net revenue more specifically, you can see in the chart that the revenue went down by 6% compared to the same quarter last year, and the revenue was 17.4 million kronor in the quarter. And the main reason for that was, a little bit weaker demand from our existing customers. We have previously in the last few quarterly reports mentioned our previous customer, RingCentral, and that the impact from the loss of that customer has not impacted the figures in quarter three. But if you look at the year-to-date numbers, the majority of the decrease in the year-to-date numbers are due to the fact that RingCentral is no longer customers. But going forward, we will not see any impact from this anymore. Going to gross profit, the gross profit in the quarter amounted to 12.7 million kronor, and that corresponds to a margin of 73%. And that's in line with what we have seen in the last kind of 12 months. And if we go back to 2023, we were about 80%, so we continue to see a little bit weaker margins. And that has also led us to have more focus also on the costs of the direct costs. So we have looked at optimizing servers and other direct costs that impact the gross margin. But the biggest impact is that, as we discussed before as well, that many of these costs are kind of fixed or semi-fixed. So as the growth is coming back, we believe that the margins will also go up because of that impact. If we look at sales and marketing costs, again, this has also been a focus area to make this more efficient and look at the costs also in this area. So we invested 2.9 million kronor in sales and marketing activities in the quarter, corresponding to 17% of net revenues. And if we look at the first 9 months, we spent around 20% of net revenues in this area. Going to EBITDA, we have already mentioned a few times that we have been focused on cost savings and optimizations and efficiencies, and that will of course have a big impact on the EBITDA, as we have seen in this quarter. And EBITDA landed on 6 million kronor in the quarter, corresponding to 35% margin. And if we look at the margin year to date, EBITDA is currently at 21% for the first 9 months. And finally, we ended the quarter with a cash position of 14.3 million kronor, and the equity ratio was 92%. And with that, I'll hand it back to Christian for some final remarks and the Q&A session.
Thank you, Martin. To summarize, Q3 2025, the growth rate was -4% quarter-on-quarter and -6% year-on-year. The EBITDA margin improved to 35%. We still have a strong cost focus, and we're expecting to reach full effect during Q4. Some important new signings after the quarter ended with Visma and Sky City, and we're expecting a few new customer launches now in Q4. And with that, I will leave over for the Q&A.
Thank you for that presentation. And yes, let's open up the Q&A section here. The total number of customers seems to be decreasing in between quarters. Can you explain the main reason behind this trend and why some customers choose to end their cooperation with you?
Yes, it can maybe look like that, but we like the last 1.5 years now, we've been focusing a lot on like different type of distribution, like platform deals, and hope to find better like distribution of our software. That means that if we working with some type of platform, it shows that it's one customer. If we just take an example, the recent deal with Visma, many of their customers will use our software, but it will just be counted as one customer. So in general, I think right now it's more customers that using a technology, but how it's reported, it probably will look a little bit less.
Thank you for clarifying that. In May of 2024, you launched a new travel product with a European airline in the Irish market, designed to handle all types of bookings. Has this product been expanded to other markets since then?
No, it's not been expanded, and right now we not really see it will be expanded for the time being.
Understood. Thank you. Given that the travel industry continues to underperform financially for you, why do you contain such a strong focus into this segment?
Yeah, like I think the travel industry has been quite good for us historically, but obviously we had higher hope for the growth in the segment. We still believe we have a lot of opportunities there, but at the same time, we also need to invest in those areas. We really see that we have the momentum right now. So I still believe in the travel industry going forward, but right now we will also spend a little bit more time and effort into other industries where we see more current momentum.
With the recent changes to the board, how will the new board structure help the company return to growth in between quarters, especially now that the financial targets has been removed?
Yeah, I can't answer behalf of the board, but I can answer as part of the CEO for the people who's working with this every day. But like obviously we've been doing a lot of changes in the organization, but it also should give us more opportunities to invest in growth. So this is something we're working with daily, and we can't just cut costs. We also need to grow our revenue. So it's a mix of things. Obviously, we're doing, but one of those is to continue to invest where we really see that we have momentum, which we see in some industries right now.
And you mentioned agreements with Visma in the report. When can we start expecting revenue from this partnership? And which business areas will your software be applied to?
Yeah, we expect them to be live in hopefully already a few weeks time, and that will then come into a revenue phase for us. Obviously, we're not expecting any large revenue this year, but we hopefully that they can really scale for the next year. As we understand, it will be part of the platform, so their enterprise partners can use the technology out of the box without like any further integration or agreement in place.
Thank you for that answer. With cost-saving measures already implemented and improved profitability, can investors expect further profitability gains once all cost reductions are fully realized?
I can I can take this one. Yeah, so with cost reductions, you have different types of cost reductions. Some of them are immediate when you just cut a supplier or a purchase order or something, whereas some take a little bit longer to materialize, and the most common of those are employee costs. And we have not yet seen the full effect from the cost saving initiatives we have already taken. So we will see those the full effect of that during Q4.
Thank you, Martin, for that answer. How do you plan to increase revenues again despite a strong focus on cost management? And how will this impact investments into sales and marketing?
Yes. No, but like over, I would say the last 6 months, we've been looking into every area of the business, especially around the cost side. And right now we are on a quite good level, and as we already talked about, we're expecting the full effect in Q4, but it will be seen probably like the full effect will be seen in the numbers for Q1. But that also is to give us opportunities to invest in growth going forward. But at the same time, be a little bit more, I should say, precise where we invest, and especially invest in areas that we see that the momentum is at this time, instead of like investing things that we maybe hope for in the future.
Thank you for that answer. The gross margin has declined over the past 2 years, but has recently started to recover. What factors are driving this improvement?
Yeah, I think that's for me to answer. Yeah, I would say the gross margin this quarter is pretty much in line with what we have seen in the last year. Maybe it's 1 or 2% up compared to the previous quarters. So and as we said, we have looked at optimizing these costs as well as part of the kind of wider cost saving programs, and especially looking at the server cost side. And we are constantly all kind of optimizing that. But I think the biggest impact, as I already mentioned in the presentation as well, is that some of these costs are fixed or semi-fixed. So as if revenue is growing, then the gross margin will go up, everything else equal, and likewise, if the revenue is falling, then the margin will go down, everything else equal. So I think that is kind of the biggest impact on the biggest explanation of the kind of falling gross margins in the last year or 18 months.
Thank you. And we'll take one final question here before wrapping up the Q&A section. Can you provide additional insights on the EBITDA margin during the quarter and where you expect it to stabilize over the long term?
Yeah, I think we covered this also. We have looked at a lot of costs in the last kind of 12 months, and and that will of course trickle down to an improved EBITDA and EBITDA margin. And for this quarter, we landed at 35%. For the longer term, I think it's hard to give any guidance right now. But if you look at kind of more mature, larger software companies and SaaS companies, it's not, it's fairly common that they are somewhere between 30 and 50%. So I would expect us to be somewhere in that area as we, grow and become more mature.
Okay, and that concludes the Q&A session. Thank you very much, Christian and Martin, for presenting with us here today and also answering all of our questions. And we wish you all a great rest of the day. Thank you.